advanced taxes, and it looks like I'm here by myself today, so we will make it probably shorter period, but still some information. Okay, Thursday we will have an open book test. Now I want to repeat that. I hope you're watching this video. We will have an open book test Thursday. I guess it's chapter 13 and corporation chapters 2 and 3. It's open book. It's in class. You're welcome to stay as long as you want to, uh, at least an hour after the class ends. And you're welcome to come early, even though I've got managerial accounting. Well, you're welcome to start at 12 o'clock. So you will have a test on those 3 chapters, the usual multiple choice, true, false. All right. I'm going to look at PowerPoint with you on chapter 3, which I haven't done. As soon as I find it. It's an old PowerPoint for the last year's book. We never did update our PowerPoint. But in this chapter on corporation, except for the rate, nothing has changed. Calculating the forward. Well, let's see, chapter 3. Let me see what the title is to make sure. The corporation income tax. Corporation gets credit just like an individual does. Again, tax deduction for ordinary and necessary expenses. Startup expenses like organizational costs they can capitalize. Organizational expenditures they have to capitalize. Charitable donation, that's still the must have a charitable intent to make the contribution. Deductions only when paid, not pledged. Now, if you're on accrual basis, you authorize the contribution, and you intend to pay it within 3.5 months. Now, this contribution of capital gain property, we discussed that. But we didn't discuss it when it comes to charity. Taxpayer contributes a forklift to the Salvation Army for use in the warehouse. The original cost of 10, 4,000 depreciation. Therefore, its book value was 6. Fair market value of the equipment is 9,000. All right, you can take what? I think a corporation could take the 9,000. That's what we'll assume for right now. Taxpayers a retailer donates 1,000 blankets of Red Cross for use in disaster. The blankets retail for 20. What is the amount of the donation? Only $5 a piece to cost. Maximum total deduction is 10%. That's good in the old book and the new book. %10 deduction on your net income before charitable deductions. And you can carry forward the unused portion for 5 years. That's what chapter 3 is pretty much about. But now if we're looking at your textbook, look at page 3-2. Choosing a calendar year or a fiscal year, a corporation can choose either. So you can have a short tax year if you want it to end the calendar year, the same as your personal taxes. And if you change, you got to have permission from IRS to change your accounting period. The accounting methods we mentioned on page 3-4 and 5, the accrual basis versus cash basis. The hybrid method is you can use accrual method for accounts receivable and accounts payable. Corporate tax rates on page 3-5 will be a flat 21%. Special deduction, as you see on the screen, is U.S. production activities deduction. I think that's 10%. The dividends received deduction up to 70 or 80%. Net operating losses, you can carry them forward if you want to. Some of these things are not in chapter 3 in your textbook. I'm going to get away with, I'm going to shut down the screen. That does not go along with our chapter 3 well enough. Capital gains and losses, as you see on page 6. Net capital gains, a corporation includes all its net capital gains. You get no breaks in a corporation. You pay the 21%. And capital losses, now if we look at example 2.3.2 on page 3.6, Beta Corporation has a net capital gain of 40, gross profits of 110, and deductible expenses of 28. The gross income is 150. Let's see. Gross profits 110. Expenses 28. Gross income is the 40,000, I guess. Let's see. Capital gain plus the 110. That means 150. Its taxable income is 122. The 28 is your expenses. So you are paying normal taxes on 40,000 capital gain. All right, I'm going to see if I can find capital losses. I don't see too much about capital losses, but you cannot take them in the year of the loss. Yeah, on page 7, top of the page, if a corporation incurs a capital loss, it cannot deduct the net loss in the current year. A corporation capital loss can offset only capital gains. They never can offset the corporation's ordinary income. So you must carry back a capital loss as a short-term capital loss, do an amended return to the 3 previous tax years and offset capital gains in the earliest year possible. All right, the loss is carried back to 3 periods. All right, if the loss is not totally assorted as a carryback, the remainder, if not absorbed, carries over as short-term capital loss for 5 years. Now you can only deduct that from capital gains. You cannot deduct the short-term capital loss from ordinary income. All right, business expenses. They do have organization expenses here. And under section 248, they may elect to deduct the first 5,000 of organizational expenditures as an expense. However, you must reduce the 5,000 by amounts by which cumulative organizational expenditure exceed 50. Although the 5,000 cannot be reduced below 0. So look at example 5. Signal Corporation incorporates on January 10 of the current year and begins business on March the 3rd. They elect September 30 year end. Thus, it conducts business for 7 months during the first tax year. During the period, January 10 through September 30, they incur 52,000 organizational expenditures. Because these expenditures exceed 50, Sigma must reduce the first 5,000 by 2, leaving a $3,000 deduction. 2,000 is that amount you went over 50. They amortize the remaining 49,000 over 180 months. Well, if you divide 12 into 180 months, I think you get 15. And you do get 15. Amortization over 15 years after you take 5,000 in the current year. Okay, startup expenditures at the bottom of page 9. These are to investigate the creation or acquisition of a business, to create an active trade or business, to conduct an activity engaged in for profit. Now, under section 195, a corporation may elect to deduct the first 5,000 of startup expenditures. However, this amount is reduced for that amount over 50, and you amortize the remainder over 180. So we're not making any difference between organizational expenditures and startup expenditures. Keep that in mind. All right, limitation on deductions for accrued compensation. If a corporation accrued an obligation to pay compensation, the corporation must make the payment within 2.5 months. So your wages payable has to be made within 2.5 months of the adjusted entry date. All right, limitation on net business interest. All right. If you look at this, for tax years starting after 17, deductibility of business interest in a given year is limited to the sum of the following. Maybe the whole amount, 30% of adjusted taxable income. The adjusted taxable income was 100,000. You could only deduct 30%, which is 30,000 taxable interest. Floor plan financing interest for motor vehicles. All right. And a given year is limited to the sum of the following. Now, that floor plan for used cars or new cars, the bank finances it. It's almost like a line of credit. But when you sell the car, you pay the bank. That's floor plan. Now, for C corporation, adjustable taxable income means taxable income computed without regard to gains, losses, business interest, NOL, and so forth. All right, now special deductions start on page 14, and dividends received deduction. I pointed this out on page 15 that corporations that own less than 20% of the distributed corporation may deduct 50% of the dividend received. If the shareholder corporation owns 20% or more of the stock, but less than 80% of the stock, it may deduct 65% of the dividends received. So you got a 50% deduction, and then you've got a 65% deduction. That changed from the new law. I want to read the first paragraph under that example and look at example 15. So dividend deduction, interest deduction, accrued wages payable deduction. I'm not worried about members of a affiliated group. Net operating loss on page 18. If a corporation deducts and exceeds its gross income for the year, you have a net operating loss, an NOL, just like an individual. NOLs arise in tax years ending after 2017, carry over to the succeeding tax years indefinitely. You don't have to carry it back. You don't have to do amended returns. It'll be limited to the carryover year to 80% of taxable income before the NOL deduction. Your limit to 80% the taxable income before the NOL deduction. All right, now they mention on page 19 these sequential deduction, all deductions other than charitable donations and so forth. Then you take the charitable donation, then you take the dividends received, and then you take the NOL. We talked about charitable donations. You can look over this brother and sister who makes it related for a control group. All right. Read this chapter well. It's open book, but you're still going to have a hard time finding some of the questions. Now you got a tax return we need to be looking at. You need to be looking at these examples in your textbook and so forth. So it's a short class. You have an open book test Thursday. Control of Corporation, chapter 2 and 3, and chapter 13. So I'm going to shut it down for now, and I'll see you Thursday.